Welcome to the 2024 forecast event. I'm Wade Lopez, CEO of Concord Wealth Partners, and to my right, I have Gary Aiken, the Chief Investment Officer at Concord Asset Management. Gary, welcome to your second forecast.
Thank you, Wade. It's great to be here.
Excellent. We have a lot of stuff to go over, and the first thing we want to do is make sure clients know that we think we know what's on their mind, which of course is inflation, what's going on globally around the world, and what we think the stock and bond market's going to do for 2024 for the first 6 months at least. The agenda we'd like to accomplish, the first thing is inflation's aftermath with a question mark, the wall of worry, 2024 outlook, and of course your final thoughts. With that said though, let's talk about inflation's aftermath and why is there a question mark?
I put a question mark after inflation's aftermath because while the Fed has done a good job so far of defeating inflation, there's still a chance that it's not over. And when I think about the Fed doing a good job or not, I try to look at the Fed's own preferred inflation measure, the dotted line, core PCE. And you can see that it's declining. And it's declining in large part because the Fed has increased interest rates, the solid line, the effective Fed funds rate. And when interest rates are above the core PCE, monetary policy is deemed to be tight. And what does that mean? When monetary policy is tight, that means two things are likely to occur. First, inflation is likely to come down. And second, the economy is likely to slow. And so we've seen both of those things happen during 2023. And so we think that in 2024, the Fed may be ready to start cutting rates.
Well, that sounds good, but if that's in fact true, then why is it still tough for our clients going to the grocery store and paying what they're paying?
Well, inflation means that prices are higher today than they were a comparable period some time ago. And the Fed likes to look at rolling measures of inflation to grade itself. How is it doing? And so when we look at shorter measures of inflation, like 3-month and 6-month rolling averages, we could see a steep decline in the slope and the pace of inflation. That's good from the Fed's perspective. But for consumers, they feel the price of goods and services that they bought last year versus the price today. And those prices are sticky, and price changes that go up rarely come down. So the consumer is still feeling like there's been about 4% inflation year over year. Now, when we think about our framework for if the Fed is doing a good job or not, we have to remember what Milton Friedman, the economist, said. He said that inflation is always and everywhere a monetary phenomenon, that it was government spending and the Fed financing those deficits with large supplies of money that caused the inflation. And my thought was that the opposite should hold true too. If the Fed started cutting the monetary supply dramatically and government spending maybe curtailed just a little bit, you could have inflation start to come down. And that's exactly what's occurred. The solid line here is the quantity of money per unit of output, which is Friedman's measure. And I've juxtaposed that with the dotted line, the level of inflation in the economy. And it seems to be working. That dotted line was growing at something like a 9% pace a year ago. But today it's only growing at about a 3% pace. And so, like you said, clients are still experiencing that prices are going up. Prices are not going down, but they're at least not going up at the same pace that they were going up last year.
Well, the other thing the clients touched base on, we heard a lot last quarter of last year, rolling into January of this year is, what about possibility of recession? I don't want to get too far ahead of ourselves, but is that a real possibility?
A recession is possible because if monetary policy is too tight for too long, the slowing of the economy can roll into a contraction where GDP declines, and that's a recession. We think that has about a 20% probability of happening in 2024. But our main scenario, we think, is that the Fed will actually be successful in returning us to a slow growth economy where GDP is about 2% growth and inflation is about 2%. Our outlier scenario, though, is that the Fed takes its foot off the brakes too early, and that combined with geopolitical conflict and supply chain disruption ends up getting us back into inflation. And that's a scary scenario.
So, Gary, that brings us to the next part of our agenda, and that's the wall of worry. Let's talk about the things clients should be aware of. And the first thing we want to talk about that seems to be coming up is all the things happening geopolitically around the globe.
The wall of worry is a psychological wall that we as investors build up in our minds, and it's filled brick by brick with different things that are going on that are major headlines in the news and in newspapers. And so the first building block for the wall of worry is going to be geopolitical conflict. Today we have real wars going on in Ukraine and in Israel. We have serious regional conflicts all throughout the Middle East. We also have cartel activity and Iranian-sponsored terrorism going on. And finally, and importantly, just under the surface are two conflicts that could come bubbling up in 2024. The first is China is thinking more and more about how it reunifies with Taiwan. And secondly, Venezuela is making rumblings about invading its neighbor Guyana for their oil resources.
And of course, that's right in our back door. So what is that going to mean to investors and also to voters when it comes to the U.S. and their involvement in making sure that globally we have free trade?
The United States Navy, since the end of World War II, has been the guarantor of free trade around the world. That is, you can be assured that your cargo will get from point A to point B, more or less because the Navy is keeping the seas peaceful. But our naval assets are not just engaged in that mission today. In 2024, we have naval assets all over the Middle East and the Mediterranean, and we have assets in and around the South China Sea. And so the Navy is going to get stretched. It's going to be deployed as it hasn't been in a long time. And so that's going to get expensive. And on top of that, there's going to be political issues with one party or one candidate jarring against another about what America's role in the world is.
Well, speaking of, just roll right into the political issues, and let's talk about the Fed, which is supposed to be obviously, their non-political arm, right? And a lot of things need to happen in the first 6 months of this year. So let's go over a timeline of what the Fed's going to do and all the political aspects that are coming up.
We have a busy first 6 months of this year, and that's going to help us build additional blocks on the wall of worry. The first wall of worry item is that the federal government still hasn't passed its appropriations bills. And so the government has to pass spending bills in January and February to fund the government. At the same time, the Republican primaries are going to be ongoing, and Donald Trump, unfortunately, is going to be in court for his fraud case and also for the January 6th case in D.C. And at the same time that all of those things are happening, the Federal Reserve has two chances to change policy. We think that if they don't change policy, lower rates or do something different in those first two meetings, it's going to be very difficult for them over the summer, because now we're into the presidential election cycle, and the Fed doesn't want to be seen as making moves that the market or voters could deem to be favoring one party or the other. Of course, we'll talk about at our halftime report an October surprise in the November election, but I think the wall of worry really will be involved in the fact that the process to fund the government is going to be highly political, and the threat of a government shutdown is going to build a block.
With all the things that are happening, let's reiterate a little bit more about the potential of a recession. That's still looming on everybody's. That's a major block on the wall. Would you agree?
I do agree. It's a 20% probability in our calculation. But if you look at this chart, which shows the recession probability as estimated by the Federal Reserve Bank of New York, it shows about a 63% chance of a recession sometime in the next 12 months. Now, that indicator showed a higher probability of recession last year, and a recession never materialized. But the screen shows a number of reasons a number of blocks on the wall of worry for us to consider the fact that there might be a recession looming.
So let's pull that block out. And is there any other proof that we can take other blocks out of the wall? Has there been any significant improvements in American households that people need to know about?
I think so. The American consumer really is the driver of the American economy and maybe even the global economy. This chart shows inflation-adjusted household net worth by income percentile. And what we can see here is that everyone from the bottom to the upper middle class, their household balance sheets are in a better position today, even after all of the inflation, than they were before the pandemic. So the American consumer is very strong still. It's very hard to imagine that we do roll into a recession if the consumer is still strong.
And I think you pointed out, you took the one percenters out of that. Is that correct?
That's correct.
Yeah. So I think that's another block we can take out, but not to add blocks back to the wall. Clients are really concerned about government spending, the amount of the deficit, and the interest that's accumulating.
Government deficits and debts are always part of the wall of worry. And I think it's interesting that we talked about the timeline for appropriations bills because they're there to resolve the Fiscal Responsibility Act of 2023's unfinished mandate. Now, there's good things and bad things from the Fiscal Responsibility Act. First is spending is going to continue to be capped until those appropriations bills are passed. But if Congress fails to act, there's going to be mandatory spending cuts. And spending cuts aren't bad in and of themselves, but our representatives are not going to get to pick and choose where the spending cuts are going to happen, so there might be unintended consequences.
It could affect their job.
Correct.
Yep.
Another potentially good thing out of the Fiscal Responsibility Act is that there's no debt ceiling, so we won't have a block on the wall of worry about a government debt default. But at the same time, that means Treasury has been able to borrow as much money as it wants, and it's been borrowing a lot of money at 4% and 5% interest rates. And that means that interest on the federal debt is going up and up. And we expect in 2024 for the interest alone on the federal debt to be over $1 trillion. And just to put that in context, that's about $120 billion more than we anticipate spending on national defense.
That's a lot. But I think one of the things that we have learned over our many years of investing now is that, even with these walls of worry, we try to tell our clients, you got to always concentrate on not trying to time the market, because it's really more important about how much time you can spend in the market. You agree with that statement?
That's absolutely correct. And this chart shows all of the events that would be at the top of the wall of worry over the last 100 years. And while they would be stumbling blocks for reasons for investors not to want to invest, the reality is that the stock market year after year over long periods of time earns about 7% a year. If you add in dividends, it's about 8 or 9% a year. And so pessimism really doesn't pay.
Pull another block out of the wall. Let's talk about unemployment, because those numbers seem to be a little better, at least for those individuals that want to participate.
That's correct. The total number of employed Americans is at an all-time high. We've got more Americans working today than we did pre-pandemic, which is great. And another reason to be optimistic is the dotted line is showing the participation rate, which hasn't gotten back to its pre-pandemic levels, but the trajectory is definitely up.
Right.
And so more and more people are coming back to the labor force. They're able to find jobs because there's over 7 million jobs outstanding available. And the important part for the Federal Reserve is that there's plenty of jobs available. There's plenty of people who want those jobs. You've got a labor market that's going to be fairly balanced, and that means that there won't be wage pressures to force a wage price spiral for inflation.
That is good news. Now, we kind of talked about the wall of worry. We touched on what we think our clients are really concerned about. Now we're getting into the fun part of this, and that's where you get to break out your crystal ball. Now I'm going to start with an easy one here. I'm going to throw you a slow pitch, and that is, Tell everybody out there what you think the stock market is going to do for 2024.
Well, Wade, I wish I had a crystal ball, but I do have a mirror, so I could at least start looking backwards with 2020 vision.
Fair enough.
And there are three things that I think really moved markets last year. The first is that the largest technology stocks really drove global stock market activity. You had Amazon, Meta, Facebook, Microsoft. Those companies were up over 100% last year, and they dragged the rest of the global stock market up with them. The second thing that I think was really interesting was that both bonds and dividend stocks performed about the same as cash. They did that with a lot more volatility, though. So cash turned out to be, on a risk-adjusted basis, a great asset. Finally, in 2023 at our forecast report, we talked about how China was somewhat of a black box and that we had real questions about them emerging from COVID-19. The Chinese stock market was down 12% last year, and that dragged down the performance of emerging markets.
I don't think you're going to be able to use your mirror on this next one, but what you got left in your crystal ball, tell everybody who you think the next president's going to be in 2024.
Oh, thanks for the softballs. So easy. I think I'll answer that as any good politician would with a question. And it's Ronald Reagan's question from 1980. Are you better off than you were 4 years ago? And the University of Michigan asks a similar question. Are you better off or worse off than you were 5 years ago? And this chart shows that more people are feeling worse off than they were at any time in the past 10 years, and fewer people are feeling better off than they were 5 years ago at any time in the past 10 years. So nothing is really predictive, but I certainly wouldn't want to be an incumbent running for re-election and everybody thinking that, hey, weren't things great when the last guy was in office? But that said, I think the main conclusion is I have no idea who's going to win the election.
Well, one thing I have learned in 30 plus years I've been doing this is presidents don't really have a whole lot to do with what the market's going to do in an election year anyway. Would you agree with that?
I've heard that too. And just to figure it out on my own, I went back and did some research, taking a look at stock market volatility over the past 5 election cycles. And what I found was that the peaks in volatility during election years tend to be centered around the kinds of things that would move financial markets in non-election years, that they're financial crises or major problems at major companies or geopolitical issues. There are very few instances where who's up in the polls and who's down in the polls has a major effect on stock market activity, even in a big presidential election year.
Okay, well, let's move away from the crystal ball and needing to mirror things. Let's talk more about the fundamental things we can reasonably look at. And our clients are used to the term price to earnings ratio because we're constantly harping on, buying things at good value. So why don't you talk about price to earnings and compare that to where we were a year ago?
That's right. Who is president, who's in the White House, who's in Congress are not as predictive as valuations.
Right.
Where you start on a valuation matters. And when we look at where the stock markets are valued today, I look at something like the CAPE ratio, the cyclically adjusted price to earnings ratio, which was developed by Professor Schiller. And we can see that stocks today, even after the run-up of 23% this year in the S&P 500, are still not nearly as overvalued as they were at the end of 2022. So stocks are neither expensive nor cheap in our opinion. At the same time, bond prices are now at about 4% interest rates. That's much better than when we were at 0%. So we think bonds are relatively fairly valued for a world where we have 2% growth and 2% inflation. Neither U.S. stocks or bonds are overvalued or undervalued at this point. So I think maybe it's time for us to finally look elsewhere.
When you say look elsewhere, that tells me there might be some opportunity. So what are we talking?
One of the areas we think may have value in 2024 is small company stocks. Now, small company stocks have outperformed large company stocks over long-term periods. But over the last 20 years, they haven't. And there's two good reasons for that. The first is index composition. And if you look at this chart, you'll see the large companies in the dark color are heavily weighted to technology companies. And technology companies have driven a lot of the stock market returns in the last 20 years. Whereas small companies are focused more in the industrial and financial areas, which haven't had as much growth. The second thing is that market structure has really changed. It used to be that the Microsofts and Apples of the world would go public very early in their life cycle as companies, and so they would be small companies for a long time before they graduated to the large company index. But now a lot of those companies are just getting their funding from private equity funds and hedge funds and going public as large companies. That said, I think finally small companies may be ready to outperform large companies.
So we touched on domestic. Let's move internationally and let's talk about what you see in the foreign market and specifically what markets you like. But before you talk about that, you talk about, again, fundamentally, how do you determine when or if or how you do invest into foreign markets?
Foreign markets make up about 35% of the global stock market. But before we're going to invest in any country or any company in any country, we want to look for three things. First, are there structural advantages that that country has versus the U.S. or areas where they're outperforming the U.S.? The second is, what's our opinion of that currency against the dollar? Because if our currency bet goes the wrong way, it could erase all the good things we've done by buying those stocks. The third thing, and most important, is that we have to invest in places that have political stability, the rule of law, and believe in capitalism. We don't want to invest in places like Russia, where our dollar can go to zero. I think there's three places around the world that offer some potential value for 2024 and beyond. The first is the United Kingdom, where inflation is coming down, and after Brexit, they may be decoupling from the very, very slow growth story of the continent. The second place is India, which is poised at some point to become the world's second largest economy, surpassing China. There's two things that are really interesting about India, which is that virtually 100% of the people have electricity, and in rural communities, the amount of people who have drinking water and running water in their homes has doubled over the last 5 years. That means that people can focus on more productive things. Finally, in Latin America, there's situations where nearshoring and offshoring will pit the U.S. against China, and also those areas may have agricultural and energy commodities that will be very valuable.
Well, let's transition that right into from equities into bonds. And Fed moved interest rates a lot in the past 24 months. So strategically, what are some changes we should expect in our portfolios for 2024?
At Concord Asset Management, we are secular bond bears at this point. We think that it's far more likely that interest rates will be higher 5 years from now than they will be lower 5 years from now. So if that's the case, we still want to focus on a short duration bond portfolio, that is, have shorter maturities. And since we're taking less interest rate risk, we think that we can take more credit risk. And so a portfolio like that would be the solid line. And in 2023, it would have performed pretty well. And even though it didn't outperform something like the Bloomberg aggregate by very much during the year, you could see that the Bloomberg aggregate went up and down and up and down, and that defeats one of the purposes of bonds. We think there's three main purposes for bonds in client portfolios. First is income, the second is balance, and the third is to provide us dry powder when stocks get cheap for us to sell bonds and buy stocks.
Taking all that into account and where you think there's opportunity, tell us how you take that information and how you're going to construct the portfolios that our clients have moving forward in the first 6 months and throughout the remainder of 2024.
We go back to our macro framework and we build portfolios from the top down. And so for our slow growth, highest probability scenario, we think that a balanced portfolio of stocks and bonds is going to do just fine. And in the event that interest rates are allowed to come down because the Fed is defeating inflation, that may position foreign currencies to outperform the dollar. The second scenario, a recession, is a tougher one because we know that if a recession is going to happen, the stock market will probably decline precipitously. But we think any recession will probably be pretty short-lived, and so we should be ready to buy stocks when they get cheap. In the third scenario, where inflation returns, that's where our short-duration bond portfolio really pays dividends because interest rates are going to have to go up. Now, a lot of people think that when interest rates go up, that's bad for the stock market. But stocks generally, over the long run, tend to be pretty good inflation hedges. Why? Because companies are really good at taking the costs that they have to pay and passing them on to their consumers.
Consumers have learned that very well over the last 24 months. So, well, Gary, that's great information. A lot to go over, but let's finish this with your final thoughts for our clients and guests for 2024's first 6 months.
I think investors are going to climb the wall of worry in 2024. And so that means increased volatility. And when I think of markets experience extreme volatility, I think of J.P. Morgan walking down Fifth Avenue when someone comes up to him and asks, "What will the market do tomorrow?" And J.P. Morgan answers, "It will fluctuate." We don't know the direction of stocks, whether they're going to be up or down tomorrow. We do know that they're going to be either up or down, though.
Right.
And so investing really consists of accepting that volatility exists and building a portfolio where we're able to sleep at night. The second thing is that when volatility strikes, we've got to be ready to buy things of value at great prices. And when I think of buying things at great prices, I think of the great value investors of the past century. And unfortunately, we lost one of those great guys this year. We lost Charlie Munger, who was Warren Buffett's partner at Berkshire Hathaway. And Charlie changed Warren Buffett's mind about just buying things that were plain cheap and introduced him to a concept called growth at a reasonable price. And that's not the only way to make money, right? We can unlock hidden value and mismanaged or misunderstood situations.
Right.
And plenty of investors just own what they know. I own an iPhone. I really like it, so I'm going to buy Apple stock. And Charlie said all successful investment involves trying to get something where it's worth more than you're paying. And I think in 2024, there's going to be volatility and chances for us to do just that. Now, with that volatility, it's going to be crucial that people focus on risk management, and that means having a solid plan. And there's nobody better to help you construct a plan that works best for you than your Concord Wealth Partners financial advisor.
Well, I certainly agree with that, Mark. Obviously, I will also say that, we tell our clients it's also important to know what's happening in their life because life changes. It could be a death in the family. It could be a dependent that they didn't think was going to have to be living in their home. Whatever those changes are, that also would help us in constructing based on timelines and their risk tolerance. And that's as important as some of the stuff we just talked about. I'd also like to throw out there that, you have family, friends, or colleagues who need help getting over their wall of worry, then, we would offer that using us as a sounding board so we can provide insight and help them move on and hopefully make great decisions about their financial future. So, Gary, we just finished a wonderful forecast for 2024. Great information, by the way.
Thank you, Wade. Happy investing in 2024.
And I look forward to our halftime report in July so that we can look in the mirror to see how your forecast went.
Looking forward to it.
Thank you.